So there's this story that I want to tell y'all, and there's a real lesson to be learned from this story, so pay attention to the end because it really could help your financial future. So back in 2017, there were 3 friends. They were really good friends, and they were all going to start their investing journey. They all decided that they were going to start putting money into their IRAs. I can't remember if it was Roth IRA or traditional IRA. I just remember that it was an IRA. And as many of you may know, there are contribution limits and there is a total amount that you can put in each year. Now, each friend had their own different investing theory. One of the friends was really caught up in the market. He watched TV all the time and he was really detailed and he knew everything that was going on in the market. He was the friend that tried to time his investments. Now, the other 2 friends had more of a strategy. They were taught financial literacy and they had a general concept that it's very difficult to time the market. It's better to put money in the market and have time in the market than trying to actually time the market. So 2017 comes by, friend 1 is still trying to time the market, and 2017 was a relatively good year, but there was some choppiness going on in the markets. So instead of maxing out the full account, he only put in about $2,000 or $3,000. The other friends, however, maxed out their account. One of the friends did lump sum investing. So at the beginning of the year, he just took his $5,500, which was the max contribution in 2017, and at the very beginning of the year, he just dumped it into the account and he didn't look back. He had his strategy, he knew which fund he wanted to invest in, and he put his money there and he just trusted his investment. The other friend, however, did dollar cost averaging. Very similar, had his fund that he wanted to invest in and had his set strategy, but instead of just dumping all of his money in the market at once, he broke it up over time. The same thing happens for 2018, 19, 20, 21, 22, and 2023. So at the end of 2023, the friends get together and they decide to look at each other's portfolios and they wanted to compare them. Whoever had the best returns would essentially win the prize money. I can't remember if it was like $50 or $100. It was a small bet and they were going to check their portfolio earnings. So we looked at the first friend's portfolio, the one who tried to time the market. In that time span, he could have put in a total of $41,500, but because he was trying to time the market and be very calculated with his investments, he was only able to put in $20,000 over that span of time. Now granted, that $20,000 turned into $30,000 because of compound interest, but if he would have been able to put in the full $41,500, his returns would have been much greater. Now you look at the other 2 friends and this is where things get a little interesting because they were able to fully max out their IRAs every single year. However, one did lump sum investing and the other did DCA, dollar cost averaging. Who do you think actually had the higher returns? The friend who actually took his money and just dumped it all into the market at the beginning of the year and let the market do its thing actually had higher returns than the friend who did dollar cost averaging. And the reason for this kind of all boils back down to that original concept. It's all about time in the market instead of timing the market. The one friend was able to get all of his money into that market and was allowing it to compound quicker over time, whereas the other friend just took bits and pieces and invested it slowly over time. Now, if you're a beginning investor, there's nothing wrong with dollar cost averaging as it's great for emotional intelligence. However, the lesson here is time in the market versus timing the market. The more money that you can put into the market and having compounding for you, the better chances you are of getting overall wealth. Now again, the first 2 friends didn't have as high returns as the first friend because he was timing the market and he actually got pretty lucky. So technically the overall percentage was lower for the other 2 friends, but because they had more money in the market, their overall gains were larger than their other friends' gains.